What's up, everybody? This is Heresy Financial, and my name is Joseph Brown. And today I'd like to discuss with you guys something that I like to call the triangle of investing, especially in these turbulent times when markets are doing unexpected things, going up when it looks like they should be going down, some assets not moving or going down when it seems like they should be going up. Questions are arising: what is less risky, what is more risky, what has the potential for long-term high returns, and the triangle of investing should serve as a helpful guide during these turbulent times. Let's dive in. I'm sure you've all seen this picture before. It's a funny comic just representing what college life is like for most. There are three choices: either good grades, enough sleep, or social life. And in college, you are able to pick two of those. If you pick good grades and enough sleep, you're not going to have any social life. If you pick a social life and good grades, you are not going to have any time to sleep. And if you pick enough sleep plus a social life, you are not going to dedicate enough time or energy to your studies, and you're not going to have the good grades. So you've got the three choices, and you can only have two of them. Interestingly, something similar exists with investing. Now, most people talk about the risk to reward ratio. People generally understand that if something has a higher potential rate of return, then you're also going to be taking on a higher amount of risk of loss. But what people don't really take into account is the fact that you can actually have both, that it's not binary between those two. You can actually have low risk and you can have high return when viewing things through the lens of the investing triangle. And at the top of the triangle is going to be easiness, or how much hard work has to be put into the investment. Okay, so take a look at this. Really soak this triangle in right here. These are the three options available to you when picking investments, and you can only choose two of them. You can't have all three at the same time. We're going to go through a couple of examples of different investments and show how they always fit into two of these three categories. Let's start off with cash, dollars, fiat currency. With fiat currency, you are going to fit into the two categories, easy and low risk. Now, as with everything, there's going to be a spectrum here. And so holding dollars is the absolute easiest you can get. You're not going to be subject to any sort of lockup period. You can hold them digitally in an account. You can hold them in cash physically at home. There's no complexity to it. It's literally the baseline. Simultaneously, it's the lowest risk in terms of its value is going to be what its own value is. It's measured by itself. It measures itself. $1 is going to be $1. Now, because it is at the extreme of being easy and at the extreme of low risk, the return is going to be at the opposite, the worst extreme. Instead of being a high return, it's going to be at a low zero return. There is no return on cash. In fact, if you watch this channel, you'll understand that the return is actually negative. You actually lose money every year that you hold on to dollars because they don't buy as much for you every single year as they did in the past. The dollar has lost over 98% of its purchasing power since the late 60s. Okay, so that is one end of the extreme. Let's go to the other end of this tri-spectrum here. Let's look at something that has a really high return and is also really easy to invest in. You don't want to do a lot of research, don't want to do a lot of work. You want the return, and you want it to be easy and simple. Plug and play, click and go. Well, on the flip side then, the trade-off, the thing you're giving up, is going to be that risk. If you have something that's easy and you have something that's high return, the risk is going to be high as well. The risk of loss is going to be really high. Now, for me, the ideal candidate for this category is going to be Bitcoin. Bitcoin is something that you can purchase with about 30 seconds worth of work really easily through an app like Coinbase or the Cash app by Square, the trading app Robinhood. There are a number of extremely easy ways to get your hands on some Bitcoin. Plug and play, click and go, and there is a good chance that the price of Bitcoin skyrockets. Now, that's predicated on Bitcoin being adopted as money. If Bitcoin becomes the organically adopted, decentralized, bottom-up chosen currency, money of the future by the people, then the purchasing power of each Bitcoin, regardless of how you measure it, is going to skyrocket. There's no doubt about that. Further than that, it's easy to get into because you don't have to buy a full Bitcoin. You can buy any fractional amount you want. You can put $1 into Bitcoin if you want. Now, your trade-off here is going to be the risk. You do have a high risk of losing it all. Bitcoin is extremely new in monetary technology. It hasn't been tested through time. You can't look back 50 years like you can with fiat money to see how economic events impact it or governments respond to it. You can't look back a couple hundred years to look at commodity-backed currencies to see how governments and economic events react to it. And you can't look back 3,000 years like you can with gold or silver, actual commodity money, to see how economic events and governments respond to it. So you don't have the ability to look back at a large data set to come up with any sort of idea about how people will react to it. You can look at its monetary properties and make guesses based off of that. And due to its monetary properties, it has the potential to explode. You also have the potential to lose everything, and a fairly high one at that. So I would place Bitcoin in the camp of extremely easy to get into, extremely high return potential, and extremely high risk as well. There's a decent chance you lose it all. And now, for the holy grail, if you're just looking at the risk to reward spectrum by itself as binary, and you're looking at something that's either high risk, high reward, or low risk, low reward, you probably wouldn't imagine that something could exist that has both high return potential and very low risk. But when viewed through the investment triangle, you see that adding in this third element will give you access to investments that are both high return and low risk. The trade-off to get both of those is going to mean that it is not easy. You are going to have to put a lot of research into it, a lot of work into it, a lot of brain power into it. It's not going to be plug and play. It's not going to be click and go. Now, I think the perfect example of this is going to be rental properties, specifically single family homes, maybe duplexes or triplexes, but I'm talking small properties holding 1 to 4 units that are residential, not commercial. This to me seems like one of the pinnacles of achieving both really low risk and really high reward, high return, but it's going to take a lot of work. To invest in a rental property the right way where you get that mix, you're going to have to find a property that is below market value, a distressed property that's going to take either your own sweat equity, you're going to have to go do the repairs yourself or spend money and hire somebody to do it for you. You're going to have to find tenants. And if you don't want to do that, you can hire a property manager that's going to do that for you. But again, then you're taken away from some of your returns, right? So it's all part of the spectrum here. And if you buy a below market value property in a decent neighborhood that stays rented, usually they're low income neighborhoods, the rent you're going to be able to charge is going to be fantastic. You put $20,000 down, 20% down on a $100,000 property. Out of state, they're probably not in an area that you're living near. You might hire a property manager or somebody you know in the area to manage the property for you. And you're easily going to be able to rent that place out for $1,100, $1,200, or potentially even more every single month. Now, if this was stock investing, that's still decent. You spend $100,000 on a stock and it produces a 10% dividend for you. That's a really good dividend paying stock. But it's not like a stock because you can actually control it. If you want to make the value go up, you can control that. You can put closets in the bedrooms. You can upgrade the kitchen. You can upgrade the bathrooms. You can redo the roof. And again, you have high control over something like a rental property because you own it. You can do anything you want to it. And before you buy it, you're picking it in a good area, low income, that's going to stay rented. You're buying a house that's distressed or something that you can do to improve the value of. All properties are one of a kind, so you can go in and you can find something that's unique. It's not going to be the same as the neighborhood next door or even the property next door. It's just going to be a lot more work, and you have to do a lot more research to make sure that you're actually getting a good deal. And the other thing is, when you buy rental properties, you're not putting 100% down like you have to do with stocks. You're only putting in 20% of your own money. Even after accounting for, vacancy and taxes and insurance and maintenance and property management fees, all the expenses that come in to being a landlord, when you look at how much money you've put into the property through your down payment, the repairs, and your monthly expenses, and you look at the cash flow that you're pulling in each month, it's very common to be receiving a return of 20, 30, 40, even 50% cash flow on your invested capital every single year. And I say this is low risk because you can control it. You don't have to purchase shares of something that might go up or down depending on if the owners of that company make good or bad decisions. It's not subject to market whims. You're looking at cash flow here. You control it. You decide who rents the place. You decide how much the value of the property is worth based on what you do to the property. You don't have to buy any property that's selling at any price. You get to choose which one you're going to get into. And so because of the level of control that you have on the value, the level of control on the cash flow, your return potential is huge. Your risk is extremely low. You're only putting down a small fraction of the total capital into the property. If you buy the right property, you can even, after you've fixed it up, you can even pull your own capital out of the property to make your total money in zero. And then your cash flow is mathematically infinite because you're getting cash flow off of it 0% down, 0% of your own money in. It's just a lot harder. You have to do your research. You have to know what you're doing. You have to know the area. You have to make the calls to the property managers, hire and fire different property managers, deal with tenants, deal with the decisions on what you're going to be doing and not. It's not plug and play. It's not click and go. And any of the decisions that you make to make it easier, using turnkey real estate companies that hook you up with good properties, using property managers that make it easier for you, the more and more decisions that you make to make the whole process easier, the less your total return is going to be because the higher the cost is going to be overall. And so the spectrum holds. Overall here, you can pretty much plug any investment into this triangle and see where it lands. It'll land somewhere in between the three. Usually something's not going to be at the extremes. Usually it will land somewhere in between. An index fund is going to be easier than picking out individual stocks, but your risk to reward ratio is not going to be as high. You are guaranteed to get the market average by investing in an index fund, which by definition is the market average. Plug and play really easy, but your return potential is not as high. Whereas if you're picking individual stocks and you're doing your research, you're putting in the work, the level of hardness of how easy it is, it's going to go down a lot, but your potential return is going to go up a lot. So anything that you're looking at, you can plug into this, and just remember that it's not just a risk to reward ratio that you're looking at. You can change the risk to reward ratio by putting in this third factor of how hard, how much work you're putting into it. Even starting your own business, that's going to be something that for the return potential, for the reward potential, is blowing the risk out of the water. You expose yourself to massive optionality, massive asymmetric returns. The amount you could potentially make to the amount you could potentially lose is enormous. It's just not easy. It's another one of those things that seems like it's probably at the pinnacle of how hard it is compared to other investing options. So that is the investing triangle for you. I hope that helps put some things into perspective, especially during these turbulent market times. And to remember, there is no free lunch, and anybody that is offering you a free lunch is somehow going to scam you into getting you to pay them for their free lunch. Thank you so much for watching. If you enjoyed the video, please hit that like and subscribe button. It really helps out with growing the channel. You guys are the best. Have a great day.